I believe that the purchasing power of the US dollar will decline over the next 10 years by 75%. And I think that the gold price in nominal terms, US dollar terms, will increase commensurate with the decrease in purchasing power. If you use $3,000 as a base, that suggests a number like 10 or 12,000 nominal US dollars 10 years out. Understand that $10,000 then won't buy you what $10,000 will buy you now. I suspect that gold will at least maintain its purchasing power. It may do substantially better than that. When the investing public adopted the gold narrative in the 1970s, gold did more than maintain its purchasing power. The price action in gold justified the narrative to the extent that investors and speculators, I would suggest, went way, way, way overweight gold. But we're not there yet, Claudia. Sorry to go on, but this is an interesting question to me. JP Morgan Chase, the big American bank, suggests that in the United States market, the market share of precious metals, all precious metals, including equities, is about 0.5% of total savings and investment assets in the United States. So it's a very small asset class. Probably more interesting, they suggest that the 40-year mean market share of precious metals is 2%. I suspect, unfortunately, and I'll qualify the unfortunately, I suspect that gold will continue to do well. Gold does well when people are concerned about the maintenance of their purchasing power in fiat-denominated savings products. I think with regards to the world's reserve currency, which say the US dollar, that those fears are very well grounded. I don't fear for the dollar in a relative sense. In other words, I don't think it'll do poorly necessarily versus the pound or the euro or the Canadian dollar or the Australian dollar. But in an absolute sense, I suspect that the dollar repeats its performance in the decade of the 1970s, where over 10 years it lost 75% of its purchasing power. I wish I didn't believe that, but I do. And if you believe that, you need to look at gold's performance in that same decade, where it ran 30-fold. I'm not suggesting, by the way, Claudia, that gold is going to go 30-fold from here. It's already up 12-fold. But I believe over 10 years that gold will, more likely than not, the nominal price will mirror the decline in purchasing power of the US dollar. Consequence of that is that, yes, I'm bullish gold.
Recent geopolitical events have reshaped global trust in the dollar. By freezing over $300 billion in Russian reserves and using the SWIFT banking system as a political weapon, the U.S. has forced other nations to reconsider their exposure. Central banks, particularly across Asia, are turning to gold as a safeguard. China, for instance, not only encourages its citizens to buy gold, but also steadily increases state reserves. This shift is about defense, protection from financial sanctions, and U.S. policy leverage. The more Washington weaponizes the dollar, the faster gold accumulates in foreign vaults.
Asian buying, at least Asian central bank buying, is a consequence of something that doesn't impact the U.S. as much. The U.S. has basically forced the Chinese central bank and other central banks to buy gold by weaponizing the U.S. dollar, in effect expropriating the SWIFT banking system, which was not U.S. property, by employing the threat of sanctions on the U.S. dollar and U.S. treasuries, and then, irrespective of how you feel about Russia, by stealing $300 billion worth of Russian holdings in U.S. treasuries. If you run a government that occasionally, in a policy sense, runs afoul of U.S. preferences, you need to look at those actions and you need to say, I need to defend myself from that. So in the first instance, central bank buying around the world in gold is often an effort by those central banks to defend themselves from the U.S. The U.S. obviously doesn't need to feel the need to defend themselves from themselves. There's also been change in China in the sense that Chinese people culturally have had a predisposition towards gold for a very long time, but private gold ownership was illegal. Now private gold ownership is encouraged. I would suspect that there was a deep well of support for gold in China that couldn't be satisfied when the Chinese government felt that gold was a threat to the renminbi. Now that private gold ownership is allowed, there is a deep, deep, deep cultural affinity for China. And remember, too, that China is a society that characteristically saves 40% of pre-tax income. So in addition to there being a proclivity for owning gold, there is also a means to acquire it. Two other attributes sadly lacking in the United States.
China's relationship with gold runs deep. For centuries, it symbolized wealth and stability, but for much of the 20th century, private ownership was restricted. Now Beijing actively supports gold accumulation, aligning with a culture where households save around 40% of income. This cultural affinity, combined with strong financial capacity, has unleashed a powerful gold demand. Unlike the U.S., where savings are minimal and risk assets dominate, China's long-term strategy is clear: preserve wealth in real, tangible value. This combination of cultural tradition and economic muscle makes China a central force in today's gold market.
I think it's early on, but I think it's already happening. I don't know that it'll unfold quickly, despite the obvious arithmetic challenges that face the US dollar, and we can go into those later. There's still an awful lot of confidence in the US. The VIX, the volatility index, is dead. It looks like the electrocardiogram of a corpse. That doesn't suggest a lot of fear. There's a lot of liquidity in the system. There is still a lot of fondness in the US for risk-off assets, small tech stocks, crypto, stuff like that. That isn't an economy that would seem to be dominated by fear. But there are undertones. In the U.S., we are taught to believe that the correct measure of the deterioration of the purchasing power of U.S. dollars is a government index called the CPI, or Consumer Price Index. And I would suggest to you that that index is a joke. At best, a lie. I believe it for the following reasons. In the first instance, when it's inconvenient, the CPI doesn't include food or fuel. You can't see all of me, but if you could see that I like to eat. An index which doesn't include lunch is of no use to me. Secondly, it doesn't include tax. If I didn't have to pay the tax, maybe I wouldn't complain so much about the index. But commonsensically, if you're an American and you look at the basket of goods and services that are necessary for the maintenance of your family, which certainly include tax, food, or fuel, you will see that the rate of inflation in the United States is nothing like 2.5 or 2.6%. It's more like 7.5 or 8%. And that realization is dawning. The same way that realization was dawning when I was a young man in 1968, 1969. It took a while for that conclusion to take hold. It probably took 5 years of being victimized by inflation before Americans noticed the gap between what their paychecks bought and what they used to buy. When that perception really took hold in the decade of the 70s, gold went from being an afterthought to being front and center in everyone's mind. Retail flows into gold, as measured by inflows into the gold-oriented ETFs and the trusts, really began between 20 and 22 weeks ago. So the increase that we saw in gold prices on a global basis didn't include U.S. retail participation until very, very recently. And I suspect, really, truly, unfortunately, that it's going to increase.
The U.S. official inflation index, the CPI, paints a far rosier picture than lived reality. Excluding essentials like food, energy, and taxes, it grossly understates true cost of living increases. For most households, inflation feels closer to 7 to 8% annually, not the reported 2 to 3%. This deception mirrors the late 1960s, when Americans slowly realized their paychecks were shrinking against rising costs. That awakening fueled the 1970s gold boom. Today, retail demand for gold ETFs and coins is resurging, signaling that Americans are again losing faith in official narratives. History is rhyming, and gold is once more stepping into the spotlight.
It depends on the investor. A rational financial planner would look at me and say, Rick, you don't need to own gold. You have a gold stock portfolio and you're the largest shareholder in Sprott, which is a brand name for gold financial products worldwide. But I own it anyway, because at 72, it's nice to sleep nights and stay calm. What gold has done traditionally over years has provided insurance. And I would still argue that the primary use for gold in most portfolios is to ensure the maintenance of your purchasing power through thick and thin, particularly thin. I'm also a gold stock investor, and that's different than gold. If you're a gold stock investor, you believe that the increase in the gold price will continue at a pace more rapid than the increase in the cost of producing gold. And as a consequence of that, producer margins will widen, free cash flow will increase, and hence the value of the business and later the share price will increase. We've seen in the last 18 months that the increase in the gold price has really fattened the margins of the best producers. And they've performed very handsomely. Not the gold equities market necessarily as a whole, but as an example, what I call the golden triumvirate, Wheaton Precious, Franco-Nevada, Agnico Eagle, the three highest quality gold mining companies in the world, have, from a large base, done spectacularly well. In prior bull markets, they run a very normal cycle. The market is led by gold, led by the fear buyer. The momentum in gold does two things. It legitimizes the precious metals narrative, but it also fattens the margins of the best, and they begin to move. When valuation disparities exist between the best of the best and the best of the rest, then the money begins to go down the quality trail. And we're seeing exactly that. This is a textbook gold bull market. I would suggest that the best of the best are investment quality. Then, when you get down to single asset producers or developers or certainly explorers, you're in the speculative realm. I do all three. I own physical gold as portfolio insurance. In my declining years, I'm increasingly an investor as opposed to being a speculator. But I can't help myself. I love the speculative sector, and I think the money's headed there. What happened is that I bought a lot of gold some years ago, and the gold prices increased. And so gold has outperformed some other components of my portfolio. Particularly, it's outperformed my cash. I've maintained a very high liquidity in my portfolio since 2022. In 2022, I sold a developed real estate portfolio, thinking that interest rates were going to go up and I was uncompetitive as a real estate investor. And most of that money is still cash. What that means is that gold's weighting in my portfolio has gone up organically without my having to buy more gold, simply because the gold price went up.
Physical gold offers insurance, but gold mining stocks amplify the upside. When gold prices rise faster than production costs, miners enjoy widening profit margins, translating into higher share values. The strongest companies like Franco-Nevada, Wheaton Precious Metals, and Agnico Eagle have already delivered impressive gains. This pattern is textbook. Gold moves first, elite miners follow, and later, speculative junior explorers surge as investor appetite broadens. We are in the early phase of a classic bull market where fear-driven demand validates gold's role before excitement cascades through the entire mining sector.
I believe that the purchasing power of the US dollar will decline over the next 10 years by 75%. And I think that the gold price in nominal terms, US dollar terms, will increase commensurate with the decrease in purchasing power. If you use $3,000 as a base, that suggests a number like 10 or 12,000 nominal US dollars 10 years out. Understand that $10,000 then won't buy you what $10,000 will buy you now. I suspect that gold will at least maintain its purchasing power. It may do substantially better than that. When the investing public adopted the gold narrative in the 1970s, gold did more than maintain its purchasing power. The price action in gold justified the narrative to the extent that investors and speculators, I would suggest, went way, way, way overweight gold. But we're not there yet, Claudia. Sorry to go on, but this is an interesting question to me. JP Morgan Chase, the big American bank, suggests that in the United States market, the market share of precious metals, all precious metals, including equities, is about 0.5% of total savings and investment assets in the United States. So it's a very small asset class. Probably more interesting, they suggest that the 40-year mean market share of precious metals is 2%, which would suggest that if we experience reversion to mean, demand for that asset class would grow fourfold in the U.S. market. On a global basis, they suggest that the current market share of precious metals relative to other asset classes is about 1%, or double the percentage in the U.S. And they suggest that the 4-decade mean there has been about 2% because of limited Chinese participation prior to the year 2000. But again, it suggests on a global basis that a mere reversion to mean would double demand for gold on a global basis in the face of a fourfold increase in the United States. I don't think those numbers are out of line. Mercifully for you, BullionStar customers can do their own reset. There's no reason why you can't have your own gold standard irrespective of government. Waiting for government to do it seems very far-fetched to me. 2 comments on that. The first thing is that people who go into government and people who elect government, frankly, don't want fiscal discipline imposed on them. The purpose of government is to steal from one constituency and deliver to another. That's what it does. Gold eliminates the probability that governments can steal from the unborn. Gold is real money and it imposes discipline. No government wants to be disciplined. They want to discipline other people. The second comment I would make is even in the United States, were they to revalue their gold, take all the gold that's alleged to be at Fort Knox and revalue it from $42 to some higher number, it doesn't do anything for the deficit at all. It doesn't do anything for the creditors either. Let's suppose that I buy some treasuries, some long-term treasuries. By the way, a highly unlikely event, but let's suppose just for fun that I did that. And let's suppose that as a consequence of $37 trillion in on-balance sheet liabilities, that the government experienced some difficulty paying me. Let's suppose now that I pull up to the White House and I say, hey, Mr. Trump, you owe me this money. I'd like my gold. Mr. Trump presides over a nuclear-armed debtor. The probability that I, as a creditor, could request payment in gold is nil, absolutely nil. So to the extent that they revalued it, they are revaluing collateral that a creditor could never seize. Even the central bankers aren't dumb enough to fall for that.
Gold and Bitcoin are often cast as rivals, yet both represent a pushback against fiat debasement. Together, they still account for less than 1% of global investment assets, tiny compared to stocks or bonds. Bitcoin offers digital portability. Gold offers centuries of proven resilience. Governments are unlikely to embrace a gold-backed or Bitcoin-backed standard because it would impose fiscal discipline, something politicians historically resist. Instead, individuals are leading the shift. As trust in fiat erodes and debt levels spiral past $37 trillion in the U.S., gold stands as the ultimate check on government excess and a hedge against uncertainty.
Claudia used a good word. It's talk. A Bitcoin reserve. What kind of reserve? In the United States, I can't speak to Great Britain, but in the United States, our on-balance sheet liabilities exceed $37 trillion, or $30 trillion net of the Fed's own balance sheet, $30 trillion net on-balance sheet debt. But the off-balance sheet liabilities, according to the Congressional Budget Office, exceed $100 trillion. Now, interestingly, the Internal Revenue Service, similar to your inland revenue, estimates that the private net worth of Americans, assets minus liabilities, is $141 trillion. So let's look at the reserve math. Collectively, we're worth $141 trillion, and just at the federal level, we owe $130 trillion. That $130 trillion that we owe is growing by $2 trillion a year on balance sheet and another $2 trillion a year off balance sheet. So what reserve? We're $130 trillion upside down. The reserve, if it exists, means that they are printing specious currency units and using them to buy Bitcoin, if that exists. It's not a reserve. It isn't the creation of wealth. It's the creation of a distortion. As to the potential competition for investor interest between Bitcoin and gold, that's a very interesting question. It's worthy to note that the market share of either asset class is less than 1% of total savings and investment assets worldwide. So the relevance of each to the global financial situation is akin to the relevance of a pimple on an elephant's behind. They don't matter. They may matter to each other, but I suspect there's plenty of room for both. I suspect myself, people are attracted to Bitcoin because of its price escalation. People who look at its utility probably think of it more as an anonymous medium of exchange, which is very attractive, to be honest. Gold is also potentially an anonymous medium of exchange, but it's much, much, much less utilitarian. You can get Bitcoin across a border in a cell phone. Getting gold across a border is a bit more challenging. So I think that's a much more interesting question. I don't see a backed currency simply because the history of governments has been, unless they owe the money to somebody more powerful than themselves, they don't pay. Why would you as a politician subject yourself to discipline when you ran on the specific promise to be undisciplined? And why, too, would you constrain yourself to creditors when you have guns and they don't?